Hey, if you're looking to scale your real estate business and you've heard that you need good systems, processes, and people, but you're running into some challenges, we have the answer for you right here today. I speak with Stephen Pesavento to talk about how he was able to scale his business in commercial real estate, focusing on people, systems, but also recognizing that he needed the incentives necessary to attract and retain the best talent. If you are looking to scale your multifamily business, make sure you check out today's conversation right here on Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Stephen Pesavento is a real estate entrepreneur and managing partner of VonFinch Capital. He's been investing full-time since 2016, completing over 220 transactions and renovating nearly 100 properties. And personally, he's transacted on over $200 million worth of real estate. Let's welcome to the show, Stephen Pesavento.
What's going on, John? Good to be here.
Absolutely. Hey, Stephen, it's great to have you. You were a guest before, so it's great to get you back on the show. How have you been, man? For those folks who don't know about you, why don't you take 2 minutes and fill in some of the gaps in your background?
Yeah, I mean, the long and short of it is, I grew up in Minnesota. I'm the oldest of 4. My first career was in management consulting, quickly left the corporate world, hated it, went into high tech, high growth startups, worked on one of my own projects. In the process, I bootstrapped that company using Airbnb back in 2013, early days. And then I realized, hey, why don't I just do this? And so went into real estate full time. Airbnb rules and margins changed. So I flipped over 200 houses in about 2.5 years, and then made the transition to multifamily, a lot more scalable. Believe me, doing 200 transactions and 100 full renovation flips. It's a lot of brain damage. And so I've been doing multifamily for the past 5-6 years and got an incredible team and a great partner and, buying across the Midwest and Colorado.
Stephen, I love hearing you talk about that journey, right? Because you were scaling your business, right? You mentioned getting out of corporate America, didn't really like that. You got into short-term rentals, Airbnbs, rules kind of changed. And then you pivoted into flipping. And it's a place I've known a lot of people start. You were way more successful at flipping than I was, because I flipped a couple of properties and said, this is definitely not what I'm cut out to do. But you did that for quite some time, did a number of projects before going to multifamily. Take us back there. Like, as you're flipping these homes and you're doing 200 flips and 100 full renovations, that's a lot of renovation projects. At what point did you say, you know what? This isn't the right path. Let me find a different strategy.
Well, I think it's like, if we go back to the beginning, when I was getting into real estate, I had, a place a lot of people who are listening and a lot of other people have experienced, is that feeling of, hey, I want to go and do this, but can I? Do I have the belief internally that it's possible for me to do that? And, when I started, I went and listened to every podcast that I could find. I listened to, hundreds of books on tape. I literally just had earbuds in my ear every day from sunup to sundown. And I was just consuming information to be able to load my brain full of all these beliefs from other people. And then I got in community and surrounded with some other people. And I saw that, well, hey, if these guys can do it, I definitely can do it. There's one mentor in particular who had done what I had wanted to do. And it blew me away, because when I actually met him, I was like, wow, this guy's not smarter than me. Like, he's a good guy. He's a sharp guy, but if he can do it, I definitely can do it. And then after building that business, like all of us, we get in with the intent, my intent was to learn as much as I could about business in lieu of going back and getting an MBA. And so I had put all that money I would have put towards an MBA into taking risk and building that business. And after about 2.5 years, I started to see, hey, well, there's a lot of really good things about this business, but there's some things that are missing. And those things that are missing in the flipping game is you don't really have repeat clients. You don't buy a house from somebody a second time for 60 or 70 cents on the dollar. And most of the time, the people who are buying those houses are individuals, first-time home buyers, second-time home buyers. So there's not a repeatability in the business. So I'm spending all of this money on marketing. I'm sending 100,000 mailers a month. I've got a whole team and a machine built to be able to bring in the right kind of prospects, but I only have one transaction that I can do with them. And so that was a big turnoff. And I was actually sitting at a pretty significant business event, and I was reflecting to myself, like, what would I change in this business? And I realized that the things that I would need to change weren't really available. So I needed to change the business that I was in. And that's one of the appeals about multifamily. That's one of the appeals about bringing in outside investors is even while I was flipping houses, I'm borrowing money from individual investors. They're making an investment into the projects that we're doing. But there was an opportunity to do that at such a larger scale. And that was the appeal of commercial real estate. The second appeal was that, yes, from a buying and selling perspective, I often do sell an apartment building to somebody else who already has bought one from me. But more importantly, the investors are the core of our business. Everything we do is built around the investors because the investors are making an investment into the projects we do so that they can create change in their financial situation. And as a result, we get paid a profit share. And so everybody on the team has a piece, everybody from the transaction coordinator to the executive assistant, to the head of investments, everybody's participating in that. And so we've built this wealth machine. And that's the thing that's really exciting about this business that I was looking to make a shift away from when it came to the transactional nature of flipping houses. And look, doing what we do today is still transactional, but that relationship can be built over decades. And that's really our intention because, if you double somebody's money and you do it, 3, 4, 5, 6 times over a 20-year period, that's a pretty significant result. And the referrals start flowing in from those people once they see what you've been able to do for them.
Stephen, I love that breakdown. You talked about, the flipping part. You looked at the business and said, okay, how do we scale this? How do I make this work a little bit harder for me? And you realized you really couldn't. The thing was, this business was very transactional. You had to spend a lot of money on marketing to find that person who was looking to sell, at a discount at the time that you were looking to buy. And that takes a lot of work. There's no repeat business there, or very little repeat business there. Versus in a commercial multifamily, you were able to do that. You were able to scale. You're focused on the actual investors as opposed to just the investment. And because of that, you're able to build relationships. You can sell apartments to the same person. You can buy from the same people. You can have investors invest in multiple deals. So you can really focus on systems and processes and scaling based on those relationships as opposed to it being so transactional. I think it's really, really good insight, especially since you were doing such high volume. I think someone on the outside might look at it and say, well, couldn't you just put more systems in place in what you were doing flipping? But it sounds like there was probably some other void that you were looking to fill when it comes to what you're doing now in multifamily as opposed to the flipping business.
Yeah, I mean, here's the truth about any type of real estate that has a low barrier to entry is that anybody can theoretically get in and do their first flip, right? Anybody can get in and do their first multifamily deal, but the barrier to entry is higher than buying, a single family home in a neighborhood that worst case scenario they move into or they rent it out. Versus in the multifamily space, although that barrier to entry keeps coming down, more people feel like they can go and do this themselves. That barrier's higher, and so that experience of building a business, a significant business, was a great support system of transitioning into another asset class in real estate. But here's what I'll say about systems and process when you're talking about flipping houses: If I'm buying a house and I'm buying it for 150 to 250,000 and I'm buying it in two different states around the country, I have to trust in my team to make those acquisition decisions because I can't fly every time we're buying a house. If we're buying 75 to 100 houses a year, that's, I got to trust in these people a lot, but I'm taking that personal risk, personal guarantee risk, and they're not. And so what I found was some of the best people in that business would get a level of confidence to say, hey, I want to go and do this myself. So you either A, have to pay them a disproportionate amount, even though you're still taking the risk, or those people end up leaving to go and try to do it themselves. They realize all the flaws in that. You see a lot of those people not continue on in the business because they realize they only knew one piece of a 3 or 4 part business. But what is really appetizing about the business that we're in is that it really is 100% about the relationships. Like, yes, we are buying real estate. Real estate is the asset, and yes, we do have to go and execute the business plan. We have to do all these things right. At the end of the day, the capital and the relationships with the capital and the relationships with the brokers and the owners are two things that are not easily transferable. Yes, an investor can go invest with somebody else, but after you've built years of trust with that person, unless you did something to lose that trust, that is an asset. That's a relationship that will continue to bear fruit for both parties. And that's a relationship that can be transformed into other types of opportunities. And so I don't see the business that I'm in is not necessarily purely real estate, although that is the asset class. The business I'm in is building trust at scale with individuals, family offices, RIAs, and being able to hand select the right type of investments and then go and execute those directly. And yes, we directly are operating and executing on these multifamily projects, but you could envision a scenario where that strategy could then be reborn into another asset class. Because the key that I found about investing is that every asset class is great at some point in the cycle, but there's a beautiful opportunity to be able to transition between the different asset classes depending on where you're at. And I still think and believe, and we're still 100% full on focused on multifamily because there's a huge need and a huge opportunity. Specifically, we're targeting that middle market, $5 to $15 million purchase price. Yeah, we'll buy a $30 or $40 million building. We're finding the best deals in the place where these institutions can't compete and the small mom and pops don't have the capital or debt relationships to get deals done today.
Stephen, I love what you said. First of all, talking about why scaling in the single family flip game was so challenging. And it's something people don't really think about, right? You listen to guys like us on a podcast or read a book, and everyone tells you, oh, just put in some systems and processes without recognizing the human component. If you've got someone else that's out there and they're the ones scouting these deals on a day-to-day basis, at some point, they're probably going to say, hey, I've done 50 of these deals now. I could probably do this myself. I literally had a call with a guy today who's wholesaling, and he told me, hey, I'm wholesaling. I got this partner, but I'm about to go out and do it on my own, so I don't have to split the proceeds. That's kind of what happens, right? You can call it greed. You can call it opportunistic. You can call it capitalism, whatever you want. But the reality is when people are that close and they see that you're making money and they believe that they can get a bigger share, many times people are going to go off if they feel like they have that knowledge to do it. Now, to your point, they may not fully understand the other aspects of the business and maybe they're not going to be successful. But the point is, it's really hard to scale when that's a big barrier you've got to overcome, particularly when you're hiring people, you're training them up, you're teaching them how to do this, and then you got to replace them every few months. For you, you made that transition to multifamily because this was more about the relationships. You don't have to worry about somebody, cutting you out or, trying to change the deal structure to make sure that they're getting more. It's about relationships. It's an everyone can eat, everyone can enjoy the proceeds. And I love the way you phrased it. You talked about building trust at scale. And when you're building trust at scale, now you're able to focus on multifamily investment opportunities, but you're not limited to that. If there are other asset classes or other investments that make sense given the market cycles, you can explore those opportunities. And oftentimes those investors will want to invest with you because they trust you as an operator at a high level, not necessarily just limited to that asset class. Can you talk a little bit more about kind of your evolution as an operator, particularly when it comes to VonFinch Capital?
Yeah, well, I think I'll expand on kind of your question, but I'll say this. The interesting thing is in any business, there's always going to be the chance that somebody who is a high level contributor in the business is going to see an
Yeah.
opportunity to be able to increase the amount of money that they're making. That's true in private equity real estate. That's true in flipping. That's true in multifamily. That's true in every asset class. But the difference is that the barrier to entry is a lot higher. Meaning you got to have balance sheet to sign on the loan. You got to have the track record to bring the capital in. You got to have the relationships. So there's many more components that are at play there. And frankly, there's a much bigger pool of capital to share. And so my philosophy is every person that I bring on the team, yeah, I can pay them the fat market salary, but I'd prefer to negotiate with them to have them underwrite the risk of the role and come in and participate. Yes, paid a salary for the risk that they're taking, but maybe they're making 70% if things don't go well. But in exchange for that 30%, they make 2 to 3 times that. So there's an amazing opportunity when you're talking about scale. Now, the challenge in this business as we sit today is, we're right at that point. We're raising, right around $30 to $50 million of equity per year, which is about $150 million of real estate. And right at that point is where you can truly bring in some incredible professionals that really know what they're doing, the kind of people that make $300,000, $400,000, $500,000 a year, and they see an incredible opportunity to be able to help support and grow a boutique firm. And they like it better than working at an institution because institutions don't want to share in the upside. They don't want to allow those people to invest. And oftentimes they're not even allowed to. So the place that we're at today and the evolution that we've gone through is our focus is 100% on bringing in the best talent that we can. We've got an incredible team. But for example, if I was going to go and do acquisitions in any other asset class, whether that was in small businesses, whether that was in another strategy in real estate, whether that's another private credit strategy outside of multifamily, the way that I would go about doing that is going and recruiting the best talent that I can possibly find and aligning my interests with theirs and their interests with the investors, because that experience that they bring to the table is invaluable. And it allows you to then go and create another platform that gives value to the investors, gives value to that individual to be able to be an entrepreneur, create a business within the business that already exists. And that's our focus. And you can see great examples of people doing this. I mean, Blackstone and Steve Schwartzman, this is exactly how they built the firm. They went out and built their relationships and raised a significant amount of capital. And then they brought on other partners. That's where BlackRock was spun out of, was a majority controlled Blackstone company originally. And so I don't have aspirations personally to grow a multi-billion dollar firm. If it happens organically, because we have the right people in the right position and there's alignment to be able to do that, amazing, right? My vision is to be able to build a business that is both enjoyable to work in, that is challenging, and that I'm working with the smartest people that there are, and that they themselves are creating wealth right alongside everyone else. It's really, the focus is creating this machine that generates wealth. And the truth is, wealth allows you to do the things you want to do in your life. It allows you to go and travel and spend time with family. And, certain people are going to spend it on private jets and fancy cars, and other people are going to spend it on being able to buy back more of their time. And whatever that is for every person, that's kind of like the intent of what we're really going after, is creating a machine that gives people the optionality to do what they want with their life.
Yeah, Stephen, you touched on a couple of really important things. One is just your vision for the company. When you talk about growth and you talk about talent, you're going to have people who are always looking for that next opportunity. What you've created or what you've identified is, hey, in the multifamily space, there's a higher barrier to entry. Most people are not going to run out and be able to do their own large apartment syndication deal by themselves, right? So they're going to have value in staying with a team versus a flip. Anyone who understands some basic things, you can go out there and probably flip a house if you understood some of those basic things. So that barrier to entry is one. But you talked about the next layer of that, which was really creating an environment where you are incentivizing success. You're tapping into the best talent. You're structuring compensation where everyone's interest is aligned. So, yes, they're maybe taking a lower base salary than what they can make, but they're also getting to participate in some of the upside. And that upside is what every entrepreneur is looking for, right? I mean, at the end of the day, as investors, that's the point. The point is, hey, if we do really well, I want to do better than this salary that I'm getting. And when you take that, not just with yourself and your company, but also with your investors, where everyone knows that, hey, if this deal does well, we all will perform and do well. It's going to allow that interest to be aligned. And I know a lot of companies don't think that way. They look at it as, hey, you get this salary to straight compensation. By structuring it in the manner that you've talked about, you really do get the best of both worlds, where that employee, they can go out and do more deals. They can go out and make sure that these deals are performing better, and they're going to get that upside compensation, but they have a floor. So it's not like going out by yourself as an entrepreneur is like sink or swim. And, maybe you don't eat today if you don't get a deal. You're in an environment where your floor is taken care of. So now it's how high can we go up on the ceiling? And I think it's a great environment, especially when you're talking about retention. I know a lot of people are having a hard time with that very point, right? Retention right now, whether it be for blue collar workers, for white collar workers, the labor force is a challenge for a number of folks. Can you talk to us a little bit more about kind of your experience and how this approach is enabling you to do a little bit better?
Well, I think it's really interesting. And as a 15 plus year entrepreneur, I can say that I haven't had a job in a very long time. I haven't worked for somebody else. Now, I do have the gift of having worked for somebody and realizing all the things I don't like about it that led me down the path to having to do it, because I think most entrepreneurs don't choose to be entrepreneurs. They have to be entrepreneurs, because most people aren't really born to be entrepreneurs. It's a very difficult path to go, but there's great upside when you do it. What blows me away is the number of people that I talk to that have gotten addicted to the drug called a salary. They're so addicted to this drug called salary that all they want is that ability to create freedom for their family 5, 10 years in the future. And they can absolutely clearly see the path to doing that, but they're hooked on this drug. And that drug makes them make choices that focus on security and certainty over growth and opportunity. And so it's very fascinating as you go out into the market and you talk to people who are at different stages in their career, and they love the idea of going out and participating, but they also want to make sure they cap their downside to the maximum limit. And so it's interesting. What I've found is that it's actually a really good litmus test. It's a really good filter to be able to talk to people and understand, hey, what is your baseline? Hey, this is what a market rate salary is. We're happy to pay it. We're happy to pay you, the market rate bonus. But here's the trade-off. If you're willing to do this, which allows us to give you the security of knowing that your role is funded for the next 5 years, as long as you're doing good at what you do, you're going to be here. And that gives you a long enough timeline to then be able to participate in the upside that you're responsible for creating. This is what this looks like. And you're a financial person. Underwrite it, look at it, understand it. But it is fascinating. I think that's kind of that's the needle mover for us. We talk to a lot of folks that have worked in big institutions and they want to make the move. But when you're talking about a small boutique company with 7 to 10 people, it does take a certain kind of person, a person who both understands institutional quality work, but also understands that they're going to wear 3 or 4 or 5 hats. They're not going to do one thing. And there's a lot of people who really want to do that. And there's a lot of people who want to do that in their head, but they're not actually the right fit. And so I think that's one of the key things. If you're growing a business or you're looking to join a business, get really clear on answering the question, what are you really good at? And what are you not good at? And what are you not interested in doing professionally? And what risk are you willing to take to get the thing that you want? And when you go into an interview and you have that information, or you're interviewing somebody and you gather that information, it allows you to make both a logical and an emotional decision on whether that's the right fit.
It's great information, just the way to frame up that approach, right? Whether you are the one looking for employment, looking for this opportunity, or you're the one looking to scale and hire folks, make sure you understand kind of that coin, right? The two sides of the coin. What are you looking for, both from an emotional standpoint, from a financial standpoint, and make sure that the offer kind of reflects that, because that's going to set you up for success. And I know that's a challenge a lot of folks are dealing with today. So I appreciate you shedding a little bit of light on the way you're approaching that. Let's talk more about the actual business, right? Multifamily investing, we know over the last 18 to 24 months, there have been a lot of challenges, which also could mean opportunities for folks. Talk to us about kind of how you see the marketplace and within your own portfolio.
Yeah, so it's interesting. If somebody's not in multifamily, commercial multifamily every day, if that's not their business, a lot of people don't realize the turmoil or challenge that's happening in the industry. And so it's a two-sided coin. On one side, there's massive pain, and those who own assets may be feeling that pain, especially if they have floating rate debt. On the flip side, that also creates massive opportunity. And so there's an old saying, when there's blood in the streets, that's the time to buy. But I'll add that when there's blood in the streets, even if it's your own blood, that's the time to buy. And so it's a really unique opportunity today. What we're seeing in particular is that institutional assets, and I'm talking assets that are 30, $40 million plus, 100 million plus, those assets are selling for prices that are pretty similar to where prices were at the peak, maybe down 10, 15%. But non-institutional assets, they're still institutional quality, but they just aren't the size of check that these big institutions want to write. Those are buildings that are maybe 5, 10, 15, 20, $25 million, where the equity check is 7 to 10 million or less. Those assets aren't getting the same offers. And so there's a huge opportunity that we've been taking advantage of since mid 2023, buying these buildings at 30 to 40% off the previous peak, and oftentimes 20 to 30% off the current appraised value. So buying at a really low basis. And the reason we're able to do that is because there's not a lot of buyers. It's one of the first times in the last 5 to 7 years that I've seen brokers begging for offers just to reset expectations with their clients. And so, we're looking at 5 to 10 times more deals to find one that actually goes to LOI. And that process is often taking 3, 6, even 12 months. There's a project I'm going to close in about 2 weeks we've been working on for 5 years. 5 years. We've been under contract for 3. Why? The reason is because some of the best deals are the deals that have fallen through and other people haven't been able to get debt or raise equity, or they find some kind of problem. And when that seller actually has a real desire to sell, when they're distressed, whether that's financial distress or the project itself, management wise, is distressed, or there's a bank issue, or maybe they're just have owned the property a long time and they've taken all the cash flow out and they didn't reinvest into fixing up the building. Those kind of assets, the last 2 years, we've been buying and, really, really buying at a steal. And so I would say it's kind of a tale of two markets. Those people who have the access to capital and those investors who are confident to take advantage of buying when other people are fearful are going to make out really well in the next 3 to 5 years when those deals exit. And a lot of people are sitting on the sidelines. And as we tape this today on April 8th, the stock market's gone down 10 to 15% in the last few days. And so it's an interesting time because there's a huge argument to why you should be investing in private assets. Now, they're not as liquid, but for that same reason, you don't have the ability to rush to sell them and lose money. And so as long as you have the ability to hold on long term, you've got good debt in place that has, the right window for how long you're planning to hold it. We've been able to do really well. And between my partner and I mean, we've had a pretty incredible track record. On 25 exits, it's been over a 56 average IRR. And now we've had challenges. 21 and 22 was the top of the market, and we bought quite a few deals. And I've got a couple not with this partner that are going through some tough times. But I think the key thing that I see is during tough times, you got to communicate way more to investors, let them know what's going on. You got to take action to go and solve those problems. But you also don't want to take your eye off the ball of buying assets when everyone else is hurting, because that's when you get the best deals and that's when you make the most money.
Steve, you just gave some really, really good insights. I think the most important one is recognizing that you can't let, past situations, past failures don't let these things dictate your decision making today. And you talked about, if there's blood in the streets, even if it's your own, that's when there's a buying opportunity. And some people really need to hear that because it's easy and it's in our nature, right? To retreat when we sense fear, when we've been hurt, when we've been injured, we have a deal that fails or a deal that's not doing distributions. It's easy to pull back and say, "Ooh, market must not be good. Let me not invest right now. Let me wait and see what's happening. Let me sit on the sidelines." And like you, I also believe that that is a mistake. I believe you should be looking at the market based on the market conditions, and you should be looking at deals that make sense based on the business plan. And the most important element is control. And the control of the exit gives you a lot of leverage. And going back to what you talked about earlier with that barrier to entry with commercial multifamily, that reigns true here too. It's not like in single family where everybody can just come scoop up properties because they're cheap now and they're available. Even though there's these deals that are discounted to your point, 20, 30, 40% off of where they were at their peaks, there's not that access to capital that many people have to go take advantage of it. So they're there. And that's the reason that they're off, even though they may still be performing. They may still be cash flowing, but people don't have the access to go out there and buy. So when you have a seller who really does need to sell or they really do want to sell, they're going to have to just take what the market is giving them. So now is the time to be very active if you are a buyer, if you're looking to build up your multifamily portfolio. This might be the best time we've seen in 10 years. So I would push you to go out there, talk to folks like Steven, start looking at deals, and don't be afraid and don't listen to all the noise that's going on around you.
Yeah, I couldn't think of a better time to be taking advantage of the volatility, right? So think about it. If everyone's afraid, let's just say you invested in real estate in 21, 22. Let's just say you started your investment career in that period. Well, you started at the top. You started at the worst time. If I would have known what was going to happen in the market, I would have gone on vacation for 2 years and come back and taken advantage. Now, fortunately, been able to weather the storm and fight the good fight with the properties in our portfolio. What I'd say is if you invested in 21 and 22, you have to invest now. Now, maybe you don't have to invest with me or somebody else, but you have to be dollar cost averaging into real estate because if you are planning for a 15% return in 21, 22, you're probably planning for a break even. Maybe you get a little bit of upside, but break even is like, that's good considering where the market's gone. But you want to be buying at the dip. And for the last 2 years, we've been hanging around a very similar place. It's hard to say, is it going to go up in the next 12 months or is it going to be 24 months or is it going to be 34 or 36 months? Doesn't matter. The thing that matters is that you have the ability to hold on to the asset and that when you buy at a low basis and you have an opportunity to add value, that you're not only going to make up for the returns that you missed buying at the top of the market, the returns you're going to make during this period are going to have the potential to be the highest returns that you're going to make in the next 10 years. And so it's really critical. I'm not a big public market investor. 99% of my wealth is in real estate and in what I do because I understand it and I have a unique insider ability to be able to create wealth. But if I was more of a public market investor, I'd be pouring money into the public markets right now. And I most likely am going to take some of my money and do that because I believe that you want to buy when everyone is, running away. I want to rush into that fire and I want to be able to hold for as long as I need to. And that's so true across every type of asset class. And the only way that you know that you can do that is if you understand that investing is a game and there's a set of rules and those rules change every single day and you never get a notification that there's different rules on the field. But you have to be aware that the rules are changing and then change your game plan in the moment to be able to pivot and take advantage of that. And that's how you really create alpha. And alpha is just more returns than you would normally.
Steven, when you talk about this being a game, I love it because, you host a podcast called Investor Mindset. And what we're talking about here is, it's less about the numbers, right? Because I think we could probably make a very clear, credible, argument that someone logically would not be able to refute. That hey, it's a great time to be investing. We can show them the deals and the the volume and what's coming down the pipeline as far as new development and why some of the issues that are hurting deals today won't be an issue in deals in the future and how you can just get longer term debt. Like we could logically communicate all those things to an investor. Psychologically, they may not be able to take it no matter what. Emotionally, there may still be a big disconnect. Can you talk about maybe lessons you've learned through your podcast or just the investor psyche to help those listeners understand what they need to do to really take advantage of today's market opportunities, despite maybe that little voice in their head that's telling them not to take any action?
Yeah. Well, the core of it is, like you said, it's the investor mindset. It's thinking like an investor. And the way the best investors think is there's a number of different philosophies that are kind of core, and they're always contradicting one another, right? And so when we're talking about emotions, we want to make decisions logically, but realistically, all human behavior is driven by emotion. And so when we can center ourselves into a place where even when things are burning down around us and there's challenges, we can center ourselves and look at the situation objectively and make a decision as if it's the first decision we're making based on the information we have, and being comfortable to then make a new decision with new information. And so really kind of the core of that is, if you recognize that investing is a game and it's meant to be played, and we're playing it for the sake of the outcome of creating a return, and that's how we measure the success or the score of the game. But when we're playing any game, we're not always going to win. So if we go into it recognizing, acknowledging that there is an opportunity for us to lose, that we're all making decisions to play this game of investing, and the result might be a loss. So that what that means is we're going to play the game in a way that we can continue to play ongoing forever. And we want to stack up as many wins as we can, and we never want to get wiped out. So that's why I would never recommend, if somebody came to me and said, hey, I've got $10 million in net worth, I want to put $9 million into your deal, I would say, no way. You're not allowed to. I won't let you. That's crazy. Like, I won't be a part of you making that decision, because that's going way too far out on the risk curve. You want to be making investments in a diversified way so that when you do have a loss, it's something that you can stomach. You can then take the lessons from it. And one person might look at a loss and they say, hey, the lesson is I should never do these kind of investments again. The other person could say, here's the things that I missed. Now I can go do these investments again, and I can be more comfortable going forward and doing that. And so that philosophical perspective is really important, because when we understand that loss is a part of playing the game, then we're more comfortable to understand that that's possible. And we're not getting our head around the idea that we always win and that's the only way. Because, if the Packers and the Patriots and the Vikings and the Bears, everyone's playing and they lose a game and they're just like, I'm never playing football again, that'd be crazy. But a lot of people do that when it comes to investing, because they have such a fear. That fear of loss is way stronger than the desire to gain. And so you got to shift that mindset to be in a perspective of learning. Every trade, every investment is an opportunity to learn. And every time that something goes well and something doesn't go well, I want to learn from it. And that's going to allow me to then make better decisions. But the core thing of all of that is you have to come back to that place of being centered, focused, intentional. And some people don't have what it takes to be able to do that on projects that are highly volatile. So I'll share one example and then I'll pass the mic back to you. Is, I was playing around in crypto. I was trading crypto, Bitcoin, Ethereum, a couple others. It was a very small percentage. But when I started with a pretty big percentage. I was playing the game. It was something to do. And I say playing because I wasn't a professional. And so it would double one day, and then my net worth would cut in half, and then it would go up. And then I realized, like, oh, I'm not really made for the volatility game. I need to pull this out and make it 1% to 5%. That's the appropriate amount in my eyes for something that has that much volatility. And I realized, like, I can only play the game as a non-professional in something that I'm going to just park and assume it's gone. Same when I invest in venture capital, making an investment in SpaceX or Momentous or some of these other small companies that have huge upside potential, but they could very well go to zero. I'm not a professional at venture capital investing, so I think of it in a different way. But when I'm investing in real estate, the likelihood of a total loss is much lower but I understand that. I can play that game. I can understand the volatility happens over a longer period of time. I have more time to react, more levers that I can pull. And so the key thing for you is to think, what kind of person are you? How do you handle seeing a total loss or a partial loss? And you need to make your investments according to that comfort level. No one likes losing money, but some people are very comfortable losing 80% of their wealth and then going all in on the next bet and making 3 or 4 or 5 times back. That's not everybody. And that's probably not you, because it's not me.
I think that's really important to understand. You talked about understanding who you are as an investor, understanding the game. And the only thing I'll add is when you look at it as a game, and if that sounds too trivial, think about it this way. Look at it based on the outcome and the goal that you have. We don't invest because we're just trying to make money. We invest because we're trying to create a certain lifestyle. And if the alternative is to investing is not investing, well, not investing is not going to get you any closer to that outcome that you're looking for. So your best bet is to take that feedback, take the lessons learned from those failed investments, make adjustments, and then continue to play the game. So I love the perspective you shared. I think it's really important for people. But if you're dealing with fear or just, maybe some challenges you're facing in the market, the alternative, you got to really sit down and ask yourself, are you saying that this goal is no longer a goal and you're just going to suck it up and work until you're 65, 70, 75 years old? And if that's the case, if that's the fear and that is the resolution you've come up with and you can live with that, that's one thing. But if you've decided that you want to create more, you want to have more flexibility, you got to lick your wounds and figure out how to make that adjustment, take the feedback that you've been given and continue to invest, continue to play the game. Hey, Stephen, for folks that want to learn more, they can connect with you and go to your website at VonFinch.com, learn a little bit more about VonFinch Capital there. And then we'll also put a link to your podcast in the show notes. Folks want to check that out. Right now, we're going to transition to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to CasmonCapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the apartment investing mastermind. Just go to CasmonCapital.com and click on the mastermind button today. Stephen, give me a failure or an apparent failure that set you up for later success.
Yeah, I would say, a failure that I had was, after I was building that company and running that Airbnb opportunity, I went to Colombia. I was living in Colombia, taking advantage of the exchange rate. And I got an incredible opportunity to work for one of my digital mentors. It was a company in Southern California. There was a connection to Dropbox and Eventbrite, and this person had led that organization forward and was a part of massive growth. And he was an online figure, and it was really incredible. Like, I loved what he was doing online and had an opportunity to go and work there. And I wasn't really interested in being an employee, but I thought, what a great opportunity to work under somebody that I look up to so much. And I took that position sight unseen, took it remote, but had to move to Southern California. And culturally, it just wasn't a great fit. He's a great leader, but he wasn't a great cultural leader for me personally. And so there was a lot that I learned in that process. And I had the gift of deciding, hey, I'm either going to be fired or this is going to be the role that I thought I came out here to do. And I got fired a couple of weeks later. And it was hard. It was a failure in the sense that I was let go. But he told me something that I already knew. He said, you should go create your own company. That's what you want to do. And that failure set me up to then go out and build the next enterprise, which happened to be VonFinch. And so I always think, like, I'm so grateful for the opportunity because I learned so much about who I want to work for, who I want to work with, the culture that's connected to it, and what I personally want to build. And I think, everything in life is connected to that.
Give me a digital or mobile resource you recommend for our listeners.
Well, I love listening to audio conversations. So, your good old podcasting app that you're listening to, or Audible. Right now, I'm really diving deep into learning Spanish again. I was conversational when I lived in Colombia. And there's a program called the Michelle Thomas Method. And you listen to it. And frankly, you can learn Spanish so fast by listening. But then you pair that with Duolingo for the vocabulary. Incredible.
All right, the Michelle Thomas Method. We got to check that out. All right, give me the book you've recommended or gifted the most in the last year.
It's a classic, Think and Grow Rich, Napoleon Hill. This book was written almost 100 years ago, and it is full of so many gems. It's the core behind so many personal development books. You might as well go back to the source. But every line in that book, each time you read it, you'll gather something different from it.
What's a daily habit that helps you stay focused on your goals?
Sauna and cold therapy, being able to sit down, really be able to think, reflect in the heat, and shock the system with cold, and then back and forth. And that's something that definitely gives me a lot of energy.
All right, give me your number one insight for scaling your team.
I think the number one insight is it's all about people across the board, people internally, people externally. The more that you can focus on really being a servant leader to those people and those clients and do what other people aren't willing to do gives you, a unique advantage.
I love it. Well, let's lighten the mood. Where are you located right now?
I'm based out of Denver.
Denver. All right. So out of Denver, give me your favorite place to grab a bite to eat.
I would say Izakaya Den Sushi is one of my favorites.
All right. Well, I have to check that one out the next time we're up in Denver. Steven, you gave some great stuff, man. I always enjoy talking to you. The big thing for me was listening to you talk about scaling your business, recognizing what wasn't working for you, transitioning into multifamily, and talking about the importance of relationships with investors, relationships with your team, and understanding what success looks like for them. Creating an environment where they're incentivized to stay with you, but knowing that the company's win is their win. And not just from a philosophical standpoint, from a monetary standpoint. The more we do on the projects you're leading, the more money you're going to make, and being able to structure deals that way so that you can retain some of the top talent that you're able to identify. Again, we talked about taking advantage of the current market cycle, looking at deals, looking at opportunities, and recognizing that, if there's blood in the street, even if it's your blood, it's still the time to buy. So someone needed to hear that. And I appreciate you sharing that information on today's show. Again, for folks that want to learn more, to connect, go to VonFinch.com. We'll put a link to that in the show notes. Steven, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.